The name is Bond. That's the name of the show. And we've been discussing India's entry into the global bond indexes with Samiran Chakraborty of Citi, Kenneth Akintewe of Abrdn, and Kaushik of Deutsche Bank. Gentlemen, thank you very much for your patience. Okay, now, Samiran, to what I'm, the point that even Kaushik has been making, is there a structural change in terms of the twin deficits that we have been talking about? Our current account came as a surplus in the fourth quarter, but okay, that's a good quarter usually. Even the full year was only 0.7. So is this current account deficit constraint, structurally lower now for India going forward?
So there are two ways to look at it. One is through the so-called savings investment balance side, and the other is to look at the subcomponents of the current account and see that what is driving this improvement in current account. So if I first take the first approach, what is a bit concerning is that India's GDP growth is coming out more from the consumption side rather than the coming from the investment side rather than the consumption side. And maybe the lower current account is a reflection of that weakness in the demand component compared to how the supply is growing. So one would expect that over time this demand will pick up to sustain this growth. And that would mean that the current account deficit would probably normalize going forward. So that's the broad outcome of the first approach. But if you take the second approach, then there are some fundamental changes happening to the current account. One is that on the export front, we are probably going to do better as we do more of these PLI type of things where we put some sort of import protection and substitute that by some exports. So if that model works in India, then one can expect that in general, that will be positive for the current account. And we are seeing huge buoyancy in service exports. That's another component and a more diversified basket of service exports, not just the IT exports.
Yeah.
And the third factor that is there is that the remittances is only growing despite all sorts of global headwinds to it. So all those factors point towards a somewhat improved current account. Our sense is that compared to the historical trend of current account hugging something like 2% of GDP, we would be more comfortable with a 1% of GDP or below current account deficit going forward. So that's definitely a big positive for India at a time when, if our forecasts are correct, then on all possible fronts of capital flows, we should be seeing a significant improvement going ahead.
Okay. Well, if there is, as Kaushik said, the budget actually goes towards 5%. Kaushik, given the combination of circumstances, this kind of stability and perhaps medium-term stability on the current account and higher tax to GDP ratio, not significantly, but gradually increasing, do you think we are in for a rating upgrade? Do you think the chances are brighter?
Yeah, definitely. I think the rating agencies have already kind of given indication that they're looking at it favorably for India. India's fiscal consolidation remains on track. I remain optimistic that this year's fiscal deficit target, given the money that the government has from RBI, even after accommodating higher expenditure, some bit of tax cuts, you can potentially show 5% of GDP or fiscal deficit target for this year, or possibly even lower at 4.9. And then next year, we can do 4.5 as per the glide path or even better. And if that happens, I think over a period of time, India deserves the ratings upgrade. Obviously, we'll have to wait and see how things go in the budget. And, next year, again, 1st February, we have the budget. So it may take some time, but we are definitely going in for a ratings upgrade expectation. Look at all the parameters. Growth, we are stronger than what we thought coming out of COVID. You can discuss the numbers, whether 7%, 7.5%, or a little lower, but we are much better than what we had thought. Fiscal consolidation remains on track despite elections, so there was no, downside surprise to that.
Sure.
The currency remains stable, as Ken mentioned. Inflation, RBI is very, very vigilant. So all these macro parameters and financial stability, if you look at NPAs of the banking system, which was a problem, 5-10 years back, that has also improved. So it is very difficult to find faults with, the Indian financial system or India macro, and not give India the ratings upgrade that it deserves, particularly, given the improvement that we made in the last 3-4 years.
See,
just
1 minute,
a small
Kaushik.
point I wanted to make you ask me about the rupee. I forgot to mention. I agree with Ken that, rupee will remain stable, but I think it'll still be a gradually depreciating kind of a currency. So today we are stuck at 83.5. But in the second half, I think we can go to 84, 84.5. But it will be a very gradually managed depreciation by RBI, and it will not be felt by the market at all. RBI will continue to buy dollars as and when money come into the economy, and build on the FX reserves.
Point taken. Sorry, I'm pushing you because my director is pushing me. I'm very sorry. Kaushik, I take your point. Actually, if you look at the Chinese yuan renminbi fixing, it's getting lower and lower, or rather higher and higher vis-a-vis the dollar. So I wouldn't be surprised if the Reserve Bank also wanted to be in step at least with the renminbi. Kenneth, 2 quick questions to you. One, how much money should we expect? There are numbers being thrown about 25 billion, 30 billion, add the Bloomberg index, 35 billion in 12 months. What is the number you have in mind in terms of flows? And secondly, will people also buy corporate bonds?
So maybe I'll start with the second question first, because that's the much easier one, because the answer is most likely not really. Buying corporate bonds is a much bigger hurdle. To buy government bonds, you have to develop an understanding of policy framework, interest rate policy. With that, you can forecast, short-dated interest rate instruments. You can form a view of the yield curve. Relatively easier to do that. If you want to buy corporate bonds, you actually need a team of people analyzing companies. And, many of these new foreign investors probably won't have teams of people just focused on India. So that will take a little bit more time, right? It will happen eventually, but it will take more time.
But how much money this year?
In terms of the flows coming into the market, the reason you hear 30 billion is because we know that there's roughly around $300 billion that tracks the GBI EM index. And we know that India will have a 10% weight. However, I said earlier on that many of these investors are struggling to get registered. So it could be possible that for the next few months, they have to use alternative means of accessing the market, whether it's structured products or supranational bonds, in which case maybe the flows would actually be a little bit softer in the initial months and then pick up later down the line. We have to see, right? And then for the Bloomberg Barclays Global Aggregate Index inclusion, we don't know what the timeline looks like. Probably wouldn't actually happen by next year, but there's $4 trillion of global money that tracks that index, right? So there's still a lot of money to come in from index inclusion. One of the things we're maybe forgetting as well is that this story isn't just about the indices, it's about the Indian bond market and its framework as well. The fully accessible route part of the bond market, which is actually facilitating this index inclusion, that continues to grow. And over the next, decade, as the fully accessible route becomes a bigger and bigger percentage of the overall bond market, there will come a time where I'm very sure the policymakers will say, look, FAR bonds are 70 or 80% of our market. We may as well just fully liberalize the Indian bond market. Obviously not this year or next year, but much further down the line. So this will be a story that's going to develop over many, many more years.
Okay, that's a very, very optimistic way of looking at the way things are. I wouldn't be surprised if the Reserve Bank is thinking on the opposite lines, actually. Should we let the tail wag the dog? Should we, put a cap on the amount of FAR bonds at some point in time? That could be a debate. But nevertheless, the important point is the very healthy medium-term story that this bond inclusion signifies. Thank you very much, Kenneth, Akintewe, Samiran Chakraborty, and Kaushik Das, for giving us the benefit of understanding what this event means. That's it on this edition of Indianomics.